Well, we're at the top of the hour now, so we want to go ahead and get started and welcome you to our Q&A panel on the new lease accounting standards under ASC 842. Sikich is happy to be able to provide this session today. Sikich is a leading professional services firm specializing in accounting, technology, and advisory services. We offer a formula of professional services uniquely crafted to address your business challenges and opportunities. And our comprehensive skill sets obtained over decades of experience as entrepreneurs, business owners, and industry innovators allow us to provide insights and transformative services to help strengthen every dimension of your business. And part of that today is going to be presenting you this information on the new accounting standards and answering questions that you have as you begin your implementation journey. Hopefully you're beginning it or already well started on it at this point, but we're here to help you along the way. My name is Greg Fiddler. I am the Assurance Director of Innovation for the firm. I've been with the firm for about 15 years now. Started my career in the audit and assurance space, mostly focused on commercial entities. With me, we have a few other panelists from around the firm, and I'm going to let them go ahead and introduce themselves as well. Brad, you want to go ahead and start?
Sounds good. Thanks, Greg. So yes, Brad Hermes. I am an audit partner with the firm. I've been with the firm about 7.5 years, and I am the head of the audit team for our office in Milwaukee. So happy to be here today.
Silas?
Well, thank you, Greg. Good afternoon, all. My name is Sailesh Babu. I'm an audit partner at Sikich, performing financial statement attest and consulting services to for-profit business entities, primarily in the manufacturing and distribution industry and business and professional service companies. Thank you for joining us today. Greg?
John?
Hey, thanks, Greg. I'm John Ouimet. I'm a manager in the audit practice here at Sikich. I've been here almost 2 years now, primarily working in manufacturing and distribution.
All right, great. And last but certainly not least, Tina.
Hi, I'm Tina Sullivan. I am the audit partner in the our Indianapolis office and am the assurance lead for our Indiana market.
Great, thank you, everyone. So we've got this group of panelists assembled from around the firm to address some questions. There are a lot of questions around the new standard. It's been in the works for 15 years. There have been a number of delays. I think those delays have even caused some questions of, do we really have to do this? Is it ever going to happen? Does it apply to me? Am I going to get scoped out of it? We're going to answer those questions and more today. We have a number of questions that have been submitted during past webinars that we didn't get to address live. We also have some other questions that just from implementations and working with clients we know are out there and are common. Questions submitted by attendees when they registered, and we're hopeful that any questions that come to mind to you today that you submit through the chat, and we will address all of those, given the time that we have. Anything that we can't get to, we will follow up after the session, so don't be concerned that we won't get to your question or won't have time. We will get back to you. The session will be recorded and available for you to watch later. And at some point, we'll also package these questions that we've received into a document that will provide access to so that you can refer back to them in text format as well. At the conclusion of the webinar, there'll be a short survey, so we hope that you stick around to complete that and provide some additional feedback. So without further ado, we'll go ahead and dive right in. So Brad, I mentioned that one of the questions surrounds, do I really have to do it? Do they apply to me? Can you talk a little bit about organizations that the standard applies to?
Sure, sounds good. So the short answer to that is yes. As long as you're preparing US GAAP-based financial statements, it applies to you. So this is a question I've gotten from a lot of people, rest assured. So, but unfortunately, I guess, or if that's the way you want to look at it, the answer really is yes. This applies to everybody with under US GAAP. So I know there were some people that were kind of holding out hope that the Private Company Council would issue some exemptions for private companies related to this. We've had no indication that that's going to happen. And in fact, beginning December 15th of 2021, any fiscal years that are starting from that date forward, the standard now applies to your business. So we're already in the period where the standard applies. So we do not anticipate any further delays coming from the FASB. And again, as long as you're preparing US GAAP-based financials, the statement does apply.
Yeah, the private company council pretty clearly shut the door on that. So if there is a private company exception at some date in the future, we'll be as surprised as anybody else on the call.
Yep.
So for those companies that really, they just don't want to implement, they don't want to do it, they don't see the value in it, what are options for those companies?
Yeah, and I think the answer to that really kind of lies in, what the users of the financial statements are anticipating, when you prepare your annual financial statements. There's really no options within US GAAP that will allow you to not apply the standard, right? So again, keep in mind, if you decide you're not going to implement the standard, you're preparing non-GAAP financial statements. So one option that is available, you could prepare financial statements under a special purpose framework, and a couple of examples of that would be cash basis financial statements or tax basis financial statements. The main warning we would throw out there to people that want to do that is, look at your debt covenants, right? If you have a line of credit or you're borrowing money, 99 times out of 100, those debt covenants require GAAP-based financial statements to be presented to your bank. So again, it certainly is a reporting option, but keep in mind that if you're required to produce GAAP financials, then you're not going to be in compliance with that, and you'd want to talk to certainly your lender, prior to making any decisions to do that. Another option, if you only have related party leases on your balance sheet, say you lease your facility from a related party LLC, one option, or I guess a couple of options that would be available to you, you always have the ability to present combined financial statements. So if you wanted to present combined financial statements that include your operating company and your leasing company, you can do it that way. Now, you'd be pulling those assets onto the books that are owned by the leasing company, but you wouldn't have to go through the mechanics of doing the lease accounting. Similarly, if your related party leasing company is a variable interest entity and you've elected to opt out of applying under one of the private company exceptions, you've elected out of applying the consolidation criteria for VIEs, you could, again, elect to go back to presenting consolidated financials in that case. Again, you're pulling the assets onto the books, you're pulling the debt of the leasing company onto the books, but if that is a more attractive option to you than going through all the lease accounting, you could certainly do that. So, and I've got a couple of clients that are actually planning to do that. So, and then finally, I guess the only other option is you present financials that are just not GAAP compliant. And if you're having a review, or any level of service, really, an audit, review, or compilation done on your financial statements, in those cases, you'd have to be prepared for the accountant to issue either a qualified, in a case of an audit, a qualified or an adverse opinion on the financial statements. Certainly an option. In my own personal viewpoint on qualified opinions is, this accounting standard is not going away. So if you decide you're not going to apply lease accounting, that qualified opinion, again, is never going away, right? So, keep that in mind. I'm strongly encouraging all my clients to just go ahead and adopt the standard because it's not going away, and you're going to be stuck with a non-GAAP reporting type situation forever unless you decide to do it. So that would be my own recommendation there.
Great. So there are some options, but maybe not great options for a lot of companies. So
exactly.
The question then moves to Silich. A lot of clients are asking, well, which leases do I have to apply this to? I heard Brad reference, related party leases. So obviously, spoiler alert, it applies to related party leases. But they've asked, does it apply to real estate equipment? What is the scope of this? Can you talk a little bit about leases that it applies to?
Sure. Yes, for the most part, the new standard applies to all leases, including related party leases, with a handful of scope exceptions which are covered under other guidance. Those exceptions include lease of intangible assets, mineral, oil, natural gas, and similar non-regenerative resources, biological assets like plant, animals, including timber, inventory, and asset under construction. So those do not fall within ASC 842. They have their own standards. It's also important to remember that new lease standards apply not only to contracts specifically called or identified as leases, but also to contracts which contain leases. For example, service contracts or similar arrangements may include the use of identified assets in providing service or goods that could qualify for lease accounting under ASC 842. Those are referred to as embedded leases. Also, there are two accounting policy elections organizations could make to scope out certain leases. One is a short-term lease, and the second one is a reasonable recognition threshold. So entities can elect to exclude short-term leases from the recognition and measurement requirements of ASC 842. For those leases, they would apply accounting similar to the prior operating lease accounting under ASC 840 by recognizing expenses on a straight line basis over the lease term. However, disclosure of the amount of expenses recognized as short-term lease expense should be included in the notes to financial statements. And to qualify as a short-term lease, these lease must be for a term of 12 months or less as of the lease commencement date and cannot have a renewal or purchase option that the lessee is reasonably certain to exercise. So that is one, short-term leases. The second one is entities could also adopt a reasonable recognition threshold, like a dollar limit, similar to a capitalization dollar threshold policy for property, plant, and equipment. If total lease payments are below this threshold, then you would not need to apply the recognition and measurement guidance in the new standard. So the answer is, yeah, it applies to pretty much all leases.
Great. So those two policy elections that you mentioned, there's a number of questions about those two that come up frequently. First, if we look at that short-term lease exception, this new standard applies to all leases that are in effect at the application date, not just new leases after it. So what about those leases that you only have less than 12 months on? Say you have 6 months left on a lease. Does that qualify for the short-term exception?
No, unfortunately, no. So the measurement consideration is as of the original commencement date of the lease, not as of the adoption date of the standard. So for example, if you have a lease with an original term of 3 years, but only 6 months remain as of, say, January 1, 2022, it would not be classified as a short-term lease. So it is based on what it was on lease commencement, original lease commencement date, yeah.
And the other election that you mentioned related to a reasonable recognition threshold, kind of like a materiality threshold for capitalizing property, plant, and equipment. But there's a lot of questions of how do you determine that? How do you establish what that reasonable recognition threshold is?
Yeah, I know we talk about maybe use the PP&E threshold as a benchmark, but you won't really use the same thing, right? And the reason is, I would say the capitalization threshold for PP&E could be more like a ceiling because for PP&E, it only considers the impact on the asset side of the balance sheet and the timing of expense recognition, right? The new lease accounting standard is going to put both the asset and the related liability on the balance sheet. Hence, you also need to consider what amount that you exclude from the liability could be material, should be considered. So you would need to be a bit more conservative when you have that dollar threshold for lease accounting.
And that threshold, the standard requires you to recognize the liabilities and assets at that net present value, that discounted value. So do you apply the threshold based on that calculation, or do you do it based on the total payments in the contract?
Sure, yeah. Although the lease liability will be calculated based on the discounted amount that is the net present value, we would recommend using the undiscounted amount for the threshold. which again, not only would be a conservative way of doing it, but also you can avoid the need to, and the time and effort, I guess, to determine what is an appropriate discount rate and having to do the present value calculation. So just go with the total lease payment, and if it is below the dollar threshold, then obviously you can not apply ASC 842. Otherwise, it would fall under ASC 842 accounting.
And one last question about that. Does that threshold then apply to the entire contract, or do you look at it asset by asset like we sometimes do with property and equipment?
Sure. Again, in our opinion, I think it should be applied on a contract level, not the asset level. One reason is, in some cases, you may be able to use the portfolio approach for lease contracts involving more than one asset, where you could account for multiple lease components as a single lease component. This could simplify the accounting by requiring just one calculation, say, for a fleet of vehicles or a group of office equipment, as long as each of the lease component have similar terms and options. So our recommendation is to use it at the contract level and not the asset level.
Okay, so you guys have now told me I have to do it, and it applies to pretty much all my leases. So if I want to try to minimize that balance sheet impact, if I want to reduce those, what are the options, or how could I minimize those liability and asset balances? John, you want to address that?
Yeah, sure, Greg. So I mean, you have a few options if you want to minimize your balance sheet impact, if that's your end goal. One way to do this would be to limit the term of your leases, right? So if you're entering into a new lease, instead of for 5 years, maybe we do it for 3 years, and then you would only calculate the lease liability and lease asset over the 3 years instead of the 5 years. I mean, you may have to, that may affect how much you have to pay or other things like that, but that should lower your asset and liability that you have to record. You can also try to negotiate payments based on usage of the asset or kind of performance of the asset. So for a machine, maybe machine hours used, or a vehicle, maybe miles that a car goes or a vehicle goes, because those payments are not fixed. You can't determine how many miles you're going to use or how much of the machine you're going to use at the implementation date. So those wouldn't be factored into kind of your asset or liability balance on the commencement date. And then you also have a few elections you can take to limit your balance sheet impact. You can decide to not combine lease and non-lease components. That will limit kind of the asset and liability you record, because you're only recording the lease components, not the lease and non-lease components. And then your choice of the discount rate, there's an election that you can use the risk-free rate or your incremental borrowing rate for most lessees. Using the discount rate makes it easier to account for those leases, but it will typically be a lower percentage than your incremental borrowing rate. So that would lead to an increase in your asset and liabilities. So incremental borrowing, if you use the incremental borrowing rate, that should limit the balance sheet impact.
So a couple of those options are more operational. They would change the way you might negotiate your lease terms and possibly open up some more variability or uncertainty for your financial statements, and a couple of those are policy elections. Talking about components is kind of one of those basic fundamental concepts of this new standard, but it also gets a bit complicated because of the policy election. Could you talk a little bit more about components? Could you expand on that concept?
Yeah, so for ASC 842, basically lumps all costs in a contract into 3 buckets. So you have your lease component, non-lease component, and then other costs, or non-components is what accountants have deemed those. So your lease component is any costs related to the use of the underlying asset. So, what the leased asset, right? So, your payment on a vehicle, your payment on, a building, things like that. Non-lease components are goods or services transferred that relate to the use kind of the underlying asset. So examples of those would be maintenance is probably the biggest one. So maintenance on a vehicle or common area maintenance for a building. And then non-components are other costs that do not transfer a good or service. So the big ones are taxes and insurance. And then again, so you have a policy election, you can account for lease and non-lease components together or separately. And accounting for them together makes it easier, right? So you don't have to separate, you don't have to determine what piece is for the lease asset and what is for a separate good or service. We can just account for all of the costs in the contract basically all together, or you would have to account for them separately for their relative standalone fair value piece, which gets a little bit more complicated. But again, like I said earlier, that could limit your balance sheet impact if that's your ultimate goal. But just from an accounting perspective, grouping them together would be simpler.
Yeah, it sounds like there's a fewer steps involved there to get to the point where you're doing your calculation. So that's likely an option that many companies will take, I think. So Tina, I'm going to move to you. If we could talk a little bit about transition. You know, we've kind of talked about what it applies to, and that I have to do it, and how I can influence it. But when do companies have to start doing all of this? When is it going to be reflected in their financial statements?
Well, the new requirements are already effective for most entities, and they will become effective for fiscal year entities during this calendar year. Well, the adoption is at the beginning of the year, but you're not actually required to issue financial statements in accordance with the new requirements until you issue your annual financial statements for the first year. The interim statements are not required to reflect the new lease accounting standards until the second year following the adoption. However, I don't believe that means you have time to wait, because waiting until the end of the year won't save you from having to perform the calculations as of the beginning of the year, as well as the income statement activity during the year. If you would wait, and then when you do implement, you may have to unwind the accounting that's already been done during the year in order to correctly record accounting under ASC 842.
Yeah, I think that's one of those misunderstandings that we keep hearing, is that clients think they have to start doing the reporting now, and that's not quite true. So when you explain to them that reporting date at the end of the year, they say, "Oh, we got more time," and that scares us a little bit as accountants and auditors. The only thing that changes if you wait is you'll have less time to do it. So if you still have any questions about that, or think that you have plenty of time to wait, give one of us a call, or your Sikich rep a call, and we'll help you walk through that. There's also questions about the transition methods, because typically changes in accounting principles are applied retrospectively. I've got to do restatements, but there's actually other options in this standard. What are those options that companies have?
Well, there's two transition methods. One is applied retrospectively to each prior period presented. That's called the comparative method. And then the other is applied at the beginning of the period of adoption, which is the effective date method. The second option forgoes comparative reporting and is a simpler approach. We expect most entities will elect for the non-comparative transition approach unless they're required to present comparative reporting by their users. Under the effective date method, in which you only apply the new guidance as of the beginning of the period of adoption, any prior periods will continue to be presented in accordance with the old standard ASC 840. This includes the financial statement presentation and note disclosures. Related to the transition, the guidance provides several practical expedients. The first is referred to as the package of three and must be adopted as a package. It's an all or none. And by electing this practical expedient, lessees are not required to reassess whether expired or existing contracts are or contain leases. The lease classification, in other words, capital versus operating, and initial direct costs, We expect most entities will elect this practical expedient. However, it should be noted that it does not grandfather incorrect assessments. For example, Silas mentioned embedded leases. If an embedded lease was not previously identified under ASC 840, that does not mean it can be excluded from ASC 842 accounting. So that's the package of 3. The second practical expedient is the use of hindsight in determining the lease term and assessing impairment. This practical expedient is really only beneficial when an entity will be presenting comparative reporting in the year of transition and must restate the prior year. As we expect that most folks will not choose the comparative method, we do not feel like this will be used very often. The third relates to easements, which we do not believe are very common either. Just be aware that if your entity has easements, which could possibly be classified as a lease under 842, there is a practical expedient which could reduce your transition efforts.
So you mentioned with the transition and the retrospective application that the standard talks about a cumulative effect adjustment at the beginning of the period of application. And I think that's caused some confusion because everybody expects there to be a cumulative effect adjustment. When are those likely to occur? Are those very common?
Well, given the package of 3 practical expedient, we expect cumulative effect adjustments will be pretty rare. If the package of 3 is not elected, the chance of a cumulative effect adjustment would be higher. There is another example. If you had a sale and leaseback accounting, if a gain were deferred under 840 but qualifies for recognition under 842, a cumulative effect adjustment to retained earnings might be required.
So you guys are all selling these practical expedients that we've been talking about. Each one of these convincing me that they will save some time and effort. So related to the cumulative effect, what about, you mentioned that the incorrect assessments aren't grandfathered in under the new standard. What if in applying or adopting the new standard, we do identify some errors in our prior accounting? For example, we didn't straight line our expense recognition and now we want to get caught up on that, or we failed to defer lease incentives. Are those types of things part of our cumulative effect adjustment at the beginning of the period?
No, Greg, those types of errors, they need to be considered for a prior period adjustment if they're material. They should not be included as part of the cumulative effect adjustment. As I mentioned before, adopting the standard does not grandfather incorrect accounting under the prior standard.
Okay, so if you're working with a CPA or an accountant or an auditor, hopefully those things aren't surprises and they've already been identified as not material, but make sure that we don't lump those into a cumulative catch-up adjustment and try to label it as such. Brad, I'm gonna come back to you. I believe embedded leases have been mentioned a couple of times now, and that's another question of, is this new? What are embedded leases? How do I identify them? Can you talk a little bit more about embedded leases?
Yeah, yep, and I think this is one of the areas, while probably not going to be the most common issue that people run into, it's certainly one of the most challenging issues in this standard that need to be addressed. And really, I think the idea here is that a company may have had contracts with where certain provisions may not have qualified as leases under previous GAAP, but may now under this embedded lease criteria within 842. So, or quite possibly in the past as well, you may have had a contract that really had an embedded lease, but the accounting really matched, right? So it didn't really matter if you broke it out. Whereas under the new standard, obviously leases are going to be capitalized and they're going to go on the balance sheet. So it's all the more critical now that we're identifying these embedded leases. And so in identifying embedded leases, you really kind of need to go back to the definition of a lease under ASC 842. And really the crux of that is if you have a contract which conveys the right to control an identified asset for a period of time in exchange for consideration. that's really kind of the basic definition of a lease. And then if you look at that idea of control of an asset, that there's two criteria that you really have to hit there. One is, can I direct the use of that asset? And two, am I obtaining substantially all the benefits of that asset? If you hit both of those criteria, then you have control over the asset. So then you got to kind of look at it and say, okay, do I have a lease here? So what are some common examples of embedded leases? I guess I'll throw two of them out there and then maybe just kind of run through some examples of contracts that you may want to look at if you have them. Contract manufacturing is one that I've seen come up. You may have a contract with a vendor and they may have a certain set of equipment that they are using solely to manufacture product for you, as an example. And you have the ability to direct the use of that equipment, how long it's running, condition of use and all that kind of stuff. In that case, you may actually have an embedded lease related to that equipment. Again, if you've hit that, those criteria for having control of that asset. So those are things to look at. IT would be another area. And again, I'll throw out something like, the use of equipment in a data center. If you've got a cloud computing arrangement or something like that, and there is equipment that your vendor is maintaining solely for you, and you have the ability to direct the use of that equipment and obtain substantially all the benefits of, again, you may have an embedded lease there. So some other things to keep in mind: transportation contracts, inventory management, cable and satellite TV contracts, billboards, and things like that. So, and again, keep in mind, anytime you have an arrangement where you're purchasing a bundle of equipment and services, right? You may look at it just as a service contract, but you really got to look at, is there equipment in that contract that I'm really leasing? So, and certainly, materiality will come into play with these types of things, just like anything else. But it's just being aware of contracts that you may have where there may be these embedded leases.
So they're not really new transactions or concepts. There's just new focus on it, because under the old standard, the income statement treatment isn't really going to change. It's just now they have to be on the balance sheet. So
exactly,
maybe a couple of good ways to look for those are to start thinking about what assets you have in your possession but you don't own. Maybe that would indicate something. Or if you have contracts that require, like you said with manufacturing, that they dedicate certain assets to the fulfillment of your contract. So good insight there. Speaking of control and considering, how do you know that you have an identified asset and control? Silas, there's sometimes confusion about what it means to be physically distinct. It's I'm using part of a larger asset. When isn't that part physically distinct?
Mm-hmm. Sure, Greg. Yeah, so physically distinct is a consideration when you're using a portion of a larger asset, and essentially means that it can be used and benefited separately from the larger asset. Say, for example, one floor of a building is clearly separate from other floors of the building and can be used independently, or a retail space within a shopping center. But however, something like the use of a fiber optic cable may or may not be a physically distinct asset. If you have sole rights to use a segment of a network, that would be physically distinct. But if you just have the rights to use a certain amount of capacity over the network, but not all the capacity, your portion of the capacity is not physically distinct from the rest of the capacity. So it's basically, you should be able to identify it and use it and benefit from it separately from a larger asset.
And related to that, the other part of that concept then of it just not only has to be physically distinct, but the vendor can't have substitution rights.
Correct, yeah.
You mentioned retail space as an example for physically distinct, but then how do you consider whether or not the vendor has substitution rights?
Yeah, for substitution rights, to preclude lease accounting, they must be substantive, meaning it's practical for the lessor to substitute the underlying asset, and the lessor would benefit economically from doing so, right? So This would be more common in service and supply contracts as opposed to real estate. Determination of substantive is intended to be a really high threshold and should be established with a reasonable high degree of certainty. So if the lessor's rights are not clearly substantive, then they should be assumed not to be substantive. Let's look at two examples. First, a company contracts for an air transportation service. The contract specifies the type and condition of aircraft, possibly with a specific aircraft identified as an example. If the supplier can substitute any comparable aircraft that is available at flight time, then its substitution right is substantive, and very likely the lessor has economic benefit from doing so. So in that case, obviously they have substitution rights. Second, let's consider the retail space in a strip mall. A lessor might reserve the right to relocate a tenant to a comparable space if and when they find a new tenant willing to pay a higher rent for that space. In this case, we could conclude the substitution right may not be substantive because one, the future event of locating a higher paying tenant may not occur, and two, it could be difficult to determine if the lessor would economically benefit after considering the cost of relocating the current tenant and placing the new tenant. So again, it's subjective, but you need to look at the substitution right and see, okay, can the lessor substitute and what the right is and whether they benefit from it.
So it sounds like that threshold's fairly high, that if it's not pretty clear that they are substantive, then you assume they don't have substitution rights.
That's right. Yeah, it's a relatively high threshold.
One of the other questions that often comes up when we're talking about using a portion of an asset relates to the classification when you're looking at whether or not your payments are substantially all the fair value. Say I'm leasing a floor of a building, maybe I can come up with the fair value of the entire building, but what do I do about just the floor? What am I supposed to do there?
Yeah, it's correct that the fair value of the underlying asset is part of one of the classification criteria. However, the good news is that FASB recognized that there could be significant difficulties in determining this amount for certain underlying assets, so it may not be straightforward, right? If the fair value cannot be determined without undue efforts, you would simply disregard that criteria and only consider the other 4 criteria for determining the classification. So that's the answer. So if you're not able to determine fair value, then just use up the look up the other 4 criteria for classification purpose.
While we're on some of these basic concepts, we've talked a little bit about control as well, and I wanted to visit some questions that come up on control, because a lot of times clients or lessees will look at their contract and say, well, the contract tells me certain things that I have to do or how I can use it. So John, can you talk a little bit about that? When the contract specifies certain things about use, how do you look at that and determine whether or not you actually have the right to direct use?
Yeah, so I mean, I would say it's not uncommon that kind of lease contracts have kind of restrictions on use or what you can use an asset for. But it's looking at, you know, as the lessee, do you have can you determine how and for what purpose the underlying asset is used for? I mean, I think the easiest way to kind of show this is going through a couple of examples. So maybe for a retail location, the retail space, you can only use it under certain hours or hours of operation, or you have to maintain a certain look or something like that. But other than that, you can still determine, you know, when you are going to operate the retail location, hours of operation, you know, who's working at the store, what you're selling. So conditions like that you would still have control of the asset, right? Another example would be on a truck to kind of transport cargo between locations. Maybe you have restrictions on mileage, or you have to transport it between A and B, but you would still, under those restrictions, you could still determine hey, we're going to transport it between A and B on Tuesday. You know, I pick the driver. I'm going to make a stop at one location before getting to B. So you have restrictions, but you can still underlying how and for what, you know, how we're getting from A to B. We're still making those decisions, right? And then finally, maybe for an aircraft, there's tons of restrictions around flights, right? On when you can fly, if there's weather delays, things like that. But as long as you can determine where you're going, or you know who's flying the plane, things like that, you still can direct control. So I would just focus on, do you have the ability to kind of how and for what purpose? I think those are the biggest ones. You know, how are we getting from A to B, or what schedule we're going, or things like that.
So contracts may set those conditions or parameters to tell you what you have to operate within. As long as you decide how to operate within those parameters or conditions, you might still conclude that you have control. So those are some good examples to kind of look at some of those conditions and not think of those as being indications of control necessarily. That you've got to think about working within those. So related to that. What if I have a lease where I lease the asset for only a few months each year? How does that affect lease accounting? I don't have control over it for an undisrupted period of time.
Yeah, so I mean, ultimately it would depend on the underlying contract, but 842 says you would have to account non-consecutive periods also apply. So if you kind of enter into an agreement for 3 years where you only get the asset, you know, for 6 months out of those 6 months each year of those 3 years, you would still have to account for the lease over kind of the 18-month term that you have control over the lease, right? So non-consecutive terms do apply to leases as well. I mean, if you just have 1 year contracts where you just have you're just using 6 months, right? That might be a short-term lease exception. But if you have long-term contracts where you're only getting, you know, maybe in the winter months you get a plow or something, right? And that's over 5 years, you would still have to account for the lease over the 5 years, just the months that you have control of it.
So you still have that control. You look at the control during the period of use, not the control of the asset for the entire scope of maybe the contract. It's just when you have the right to use it. Somewhat related to looking at a unusual lease term where it's certain months each year. We also have a number of clients asking questions about lease term when it's not clearly laid out. Maybe it's just month to month. Maybe it's an evergreen lease where there's it could be an annual lease that renews indefinitely. Tina, can you talk a little bit about lease term and how you determine what the lease term is for a contract?
Sure, thanks, Greg. So the lease accounting should be based on the legally enforceable terms and conditions of the contract. So it would not be enforceable if both the lessee and the lessor have the right to terminate without permission from the other party and with no more than an insignificant termination penalty. It's a little bit more clear when it's the leases between unrelated parties because oftentimes the terms are more clear, but it can be more complicated when you have leases between related parties where the written terms are not the true intention or the complete agreement between the parties. However, I go back to the first thing I said is related party leases should also be accounted for based on legally enforceable terms and conditions. But when it becomes related parties, it's sometimes legally enforceable is less clear. So I'm going to read the definition of lease term in 842. It includes all periods, if any, covered by ordinary renewal options during which any of the following conditions exist. A guarantee by the lessee of the lessor's debt directly or indirectly related to the leased property during the time it is expected to be in effect. And 2, a loan from the lessee to the lessor directly or indirectly related to the leased property is expected to be outstanding. So that those couple situations could extend the term of what is actually written down for the lease period. There's 5 things I want to also bring up that we should consider for related parties. The significance of leasehold improvements and whether the lease term is consistent with the useful lives of the improvements. So it would not be reasonable to have a leasehold improvement with a 7-year life on a month-to-month or short-term lease. Additionally, sometimes the lessor asserts that they'll reimburse the lessee for any unamortized costs if the lease should terminate. But what that does is it's in essence of a termination penalty. The second thing to consider is, as we talked about a little bit above, is whether the underlying asset is directly or indirectly financed through debt provided by the lessee or a debt guarantee by the lessee, and that debt will be outstanding longer than the stated lease term. This could include cross guarantees or collateral agreements. The third thing to consider is whether cash flow from the lessee is critical to the lessor's ability to meet debt obligations. That could come into play. And 4, whether it would be commercially disruptive and economically unrealistic for the lessee to relocate in the short term. And 5, in some other agreements, such as management, operating, shareholder agreements that could impose restrictions on either party's ability to terminate or modify the lease.
So being familiar with this and being an auditor, I hear you telling entities out there that if they're going to scope out their related party leases as short term, their auditors are going to be asking for have they considered those other factors? Are there other things that they need to combine the agreements on and consider together, and not just look at that lease in isolation? So those are some good pointers there. We've had a couple questions about variable lease payments, so I'm gonna move us to the variable lease payments. And John, I'm gonna come back to you on that one. Variable payments can be a little bit confusing because the standard says some are included, some variable payments are included in measurement, other variable payments are not. Can you talk a little bit about the differences in the types of variable payments and when to include them?
Yeah, so 842 basically puts variable lease payments into 2 different buckets. Variable lease payments based on an index or a rate. So you're looking at, let's say you have a kind of a lease that your payments each year increase with CPI or are based on LIBOR or, the prime rate, any sort of index or rate where your periodic payments are based on. Those are based on an index or a rate, and those are included within your calculated asset and liability balance. The other bucket are non-index and a rate variable payments, typically usage or performance based. Usage kind of, machine hours, miles driven, percentage of sales, things like that. And so those would not be included within your kind of calculated asset and liability balance because those are undeterminable, how many machine hours you're gonna use or anything like that. So the variable payments based on an index or rate that are included within kind of your calculated asset and liability, you use the rate at the commencement date or the adoption, your ASC 842 adoption date. So for example, if you're adopting 1/1/2022 for existing leases, you would use the index rate there. For new leases going forward, when the lease commence, you would use the index rate at that date to calculate kind of what each of your future payments would be.
So when you say the index or rate at that date, if I have future payments that are based on changes in the index or rate, if it's based on CPI or other inflation adjustment factors, do I count those future increases in my initial measurement, or is that initial is that change initially zero? How do you treat that payment schedule?
So you would use whatever the rate was at the commencement date or adoption date, right? So let's say CPI on the date of adoption is 2%. You had 50K is your yearly payment. Then you would assume a 2% increase year over year because that's what the index was at the date of adoption. And then, any deltas between actuals and what you calculated would kind of just flow through the P&L once you get to that year, right? So
it sounds like you might have an example there where you mentioned a 2%. So if it says it'll be based on future changes, but you have to pay some minimum amount, then you might include that minimum amount. If it's 2%, that it says you're going to pay this much of the change in that because it's somewhat fixed. But if it's an unknown change, it's not just like a multiple. If it's a change in that rate, well, at commencement, there is no change. You don't know what the change is in the future. So you're going from now to now and it's zero. So I think you hit it on the head there with, in the future, that change would be a variable rent portion. And I also, kind of what I heard you talk about in there with, ability to avoid it, not to oversimplify, but with the variable payments, it sounds like if it could possibly be zero, if you could do or not do something and the payment zero, then you probably exclude it. But if you can't avoid it, you're going to have to pay something, then it's probably a variable payment that's included at some amount. So maybe that's oversimplification, I'm not sure, but related to that. Go ahead.
I mean, just to add, that's a good point, but just to add on, let's say you have some sort of payment schedule where it's based on, how many hours you use a machine, right? But it's like 500, you have to pay $500 or, 20% of the hours used. You're going to at least pay 500, right? So you would have to include that as part of your payments. Whether or not you pay 500 or the variable amount, that's to be determined, but you're at least paying the 500.
Mm-hmm. What about, there's sometimes confusion or not clear guidance on when a renewal period in the future says you can renew for another 2 years at current market rates at that time. We don't know what those market rates are going to be. We'll figure it out upon renewal. What do you do with those renewal periods if you are reasonably certain to exercise?
If you're reasonably certain to exercise, you would also include those payments within your calculated asset and liability. And like we previously said, right, you won't necessarily know what market rates are or what the index would be, but you know the floor basically. So you know what you're paying now. You can have a reasonable assessment on what your floor would be for that your payment for the lease.
Okay, and then being conscious of time here, and we've got a number of questions yet. So as I mentioned, we'll make this information available. Anything that we didn't get to, we'll still provide responses back to you. But maybe Brad, we could quickly talk about discount rates. If you want to touch on what the different discount rates are that you might use and when you'd use a risk-free rate.
Yep. No, sounds good, Greg. And this is, again, one of the more frequent questions that I get and I think the reason for that is once you get to the actual accounting for this, step one, if you have an operating lease is, okay, I need to put a liability on the books, right? And in order to calculate a liability, which is essentially the present value of my future payment stream, in simple terms, I need to know what the discount rate is, right, in order to get to that present value. So the standard allows us 3 different options for choosing a discount rate. And the first option is if there's a rate implicit in the lease, we're actually required to use that rate. So, and then the second choice, if there's not a rate implicit in the lease, the second choice is to go with an incremental borrowing rate. Option number 3 and this is a policy election, and we talked about this a little earlier, is to choose a risk-free interest rate. So just kind of expounding on that. So I'll just kind of quickly go through the three different choices here and give you 30 seconds on each one. So the rate implicit in the lease is essentially, if you know thinking about the math behind it, if I know the rate that's implicit in the lease, either somebody's given me the rate or I know the fair value of the asset, right? So if you think about the math, and I know what the fair value of my asset is, so essentially then I know the present value of my payment stream, then I can kind of calculate what the interest rate that's implied in the lease is. And so, when you're deciding between leasing or buying an asset, sometimes you'll know what the fair value of the asset is. So in that case, you can really determine what that rate is. So that's the easiest type of scenario. And often with related parties, you'll know what the rate is too, right? So if a related party is kind of the one charging the lease payments, generally speaking, you'll be able to get information from them to determine what that rate is. So if you don't have that and you have to choose between an incremental borrowing rate and a risk-free rate, people often come to me and say, okay, I'm going to choose my incremental borrowing rate. So I'm just going to look at my line of credit, that I'm currently, borrowing on and choose that interest rate. Well, that may be a way, that's a starting point, I think is probably the best way to say it, right? So, generally speaking, the standard says the incremental borrowing rate is the rate that a lessee would have to pay to borrow on a collateralized basis over a similar term and essentially in a similar environment. So it's not as simple as just looking at my line of credit, but you can use that as a starting point and then adjust for those other factors, right? So a line of credit doesn't take into account a term, right? So things like that. So I have to kind of consider what the term is, and obviously the longer the term, the lower the rate, as an example. So so things like that can play into it. And then I guess the other thing to consider there is you may need to consult with a third party, right? So if you've got a lender that you trust, you could certainly just go and say, okay, here, I need to kind of, if I was to purchase this asset under similar terms that I'm leasing it under, what interest rate would I be paying? So there's ways to determine it, and again, it's just not as simple as just plucking a rate out of the air. I know as an auditor, I'm going to require my clients to kind of put some thought process into it. And then, so the final option, that policy election to choose a risk-free rate. One thing to keep in mind, if you do want to go in that direction, again, it's probably the simplest way to come up with an interest rate. And if you do this, you can go to the U.S. Treasury website and look at daily Treasury yield curve rates for the term for a similar termed debt instrument and come up with a risk-free rate. One thing to consider is you have to do that for all assets within a class if you decide to do that for a certain lease. So if I'm going to do that for, let's say, a lease of well, let's just throw real estate out there. I'm going to do that for a real estate lease. If I've got 3 other locations that I'm leasing, I have to do that for all of those. So you have to make that election by class of asset. And then the other thing to keep in mind, and again, we mentioned it earlier, if you do choose that, that risk-free rate, it is going to result in higher liabilities because you're going to choose a lower rate by doing that, which is going to, when you plug it into your present value calculation, it's going to kick out a higher asset and liability. So your balance sheet's going to be grossed up even higher in that situation. So hopefully, Greg, that answers kind of some of those questions around discount rates.
Yeah, that was great. And John touched on that risk-free rate early in the session as one of those ways to affect the balance sheet impact, I think. And by doing that, you're going to have that implicit rate and the incremental rate are not all that easy to get to. So the risk-free rate, if it makes sense for your company, is really a great option. So I know we're up here against the end of the hour. We didn't get to everything. We will respond So if you have any other questions still, feel free to put them in the chat as you exit, or go ahead and put them on the post webinar survey. I think there will be a spot there for you to provide any questions you have. And if I am sharing my screen now again, you've got our contact information up here if you want to reach out to any of us individually, email. Feel free to do that. Take a screenshot if you need to real quick to get those email addresses. There is a lot of other information that we didn't quite get to cover, other discount rates, related parties, incentives, and things. But we also have a wealth of information out on our website. So visit the sikich.com website and look for our lease accounting landing page. You'll find inside articles about a number of these topics. You'll find information about our lease or lessee ledger accounting solution to help simplify this process for your company, and a lot more. And at some point in the future, we'll publish all of this information we covered today and the things we didn't get to out there as an insight article. So stay tuned and keep that on your reading list. And we look forward to connecting with you. So thank you again for your time, and please fill out that survey.
Thanks, everybody.
Thank you. Thank you all. Thank you, Greg.